Hey, welcome everyone. Glad to get started here today with you and Adam Lee. By now, you know us from watching all these videos. Previously, the videos we've been doing have been targeting people that aren't our clients, maybe kids of clients, things of that nature. We thought those videos may help people that we can't help, and we're going to switch it up a little bit. You may see us doing a little bit more in-depth videos, a little bit more in-depth, diving into certain topics, maybe topics that are more advanced than we've done in the past. And also the format may be a little different. Instead of doing 5 or so different videos, Adam and I are going to take our shot at kind of doing a long form conversation and then chopping it up into smaller videos later that may be more digestible. But what we found and the feedback we've gotten from people that have watched our videos is just that, hey, we love the videos, but we'd like you to go dive even deeper on certain things. And what if you just made it like a podcast? So this is our foray into that space. Also got some feedback about adding something to the background, a little color. So you'll be seeing some changes on that. We do have a tree for this video. So we're going to keep these fun. We're going to keep them pretty light and engaging. But we're gonna make it more of a conversation and see how that goes. So today we're gonna do just that, and we've got a list of topics, all having to centrally do with how we enhance investment experiences for clients, and how individuals out there that we don't help can enhance their own investment experience. And so we're just gonna dive right into that. And the first thing that we want to talk about a little bit is just market prices. So let's go through, do people trust market prices? If they do, give some examples there, and then maybe we just riff back and forth a little bit.
Absolutely. That's a question, we get, maybe not that specific question, but we get different versions of it. Basically, that's the question being asked. Hey, I heard this news about this company. Should I go buy the stock now? Or, this I think is about to happen. I heard this on the news. That might affect this company this way. Should I buy or sell that stock of that company? One analogy I like to go back to, because it's just really simple, is the grocery store. When you think about when you're driving to the grocery store and going to buy groceries, what does that look like? Are you driving to 12 different grocery stores in town, trying to find the absolute best grocery store to buy apples at? Are you trying to predict the weather and the growing conditions for the apple harvest this year and try to get some information that maybe the grocery store doesn't have about apples, future prices, so you can kind of plan your apple buying accordingly? Like, no, you kind of understand that the grocery store is in a competitive environment with other grocery stores. They're pricing competitively, and that they probably know a lot about apples. It's their business to know a whole lot about apples. So you trust those prices when you go to the grocery store. And there's sometimes a temptation in the stock market to not trust the prices, but it doesn't make any sense, right? Kind of a fun stat we have is, every day over 50 million shares of the company Apple, do you get the pun here that I'm going for? The company Apple, over 50 million shares every day are traded. And that's way more apples, way more than actual apples are sold every day in grocery stores. And so you just think of something like that. There's tons of professionals every single day buying and selling this stock with really good information about the future prospects for the company. It's going to be really, really hard for any individual to know better than the market price on that particular day for that stock. Now, that might make you wonder, okay, like, what's the point of asset allocation? And we're going to get into that later. But the point here is that at any given time, in most competitive markets, the price for something is probably the reasonable price to pay for it at that point in time. Now, in the future, you may expect different rates of returns for different assets over time, but the actual price on that day is usually fairly priced, and trying to outguess a bunch of other professionals in the market is a really, really difficult way to try to make money in the investment world, and something you should probably stay away from.
Yeah, and it's not something you do in the grocery store. Okay, on the asset allocation, I'm going a little off script here already, but in this format, that's what we're going to do. So as you were talking, I just had this thought of you mentioned asset allocation, but when you were talking about apples at the grocery store, I also had this thought about gasoline prices. And if apples are expensive, I don't decide, okay, I'm going to buy less apples today and I'm going to go load up on gasoline because I think it's a little cheaper than it should be. You know, the same can kind of be said for asset allocations. Like, well, you have to make sure you actually need that before you decide to buy the other thing, right? Because apples and gasoline are two very different things. You don't get much nourishment from eating or drinking gasoline, right?
Yeah.
So does my portfolio actually need this? And then the question is it fairly priced? Which is maybe a question the everyday investor, you know, shouldn't really even be asking because the market's efficient and usually gets it right. But do I actually need this? Is it fairly priced? And then, okay, where can I supplement that part of my portfolio? But I have to make sure that I have the right amount of apples before I look at anything else. So I think really in this example, like that is some asset allocation, is making sure, you know, that's what I need in my portfolio instead of worrying about, is it fairly priced, or am I getting a discount today, or can I find it better on this, you know, exchange?
Absolutely. I mean, this goes into a lot of the work you always do with clients of like, it starts with a plan, and from the plan you might get, you know, some goals. The goals will in turn determine the investment strategy. The investment strategy will determine sort of the allocation, and then once we have an idea of the allocation, then we go look at the funds.
That's it.
And the products to, you know, so it's like, if you're, you know, first the apple, you know, just to extend that metaphor as far as we can, first you decide, okay, my kid is hungry. I'm going to make them lunch. And I'm going to make them a sandwich plus a side. I want that side to be healthy. I want it to be fruit. I'm going to go buy an apple. You don't start at the grocery store and think like, I don't know, that's a cheap apple. Do I need apples today? Do I not? You know, you start with a goal in mind, and then you work your way down to the product.
That's super helpful.
Well, one thing I'll pose to you, Jake, you know, we get questions a lot of times from clients about different assets, and it can be kind of a tough thing to hold in your mind of, okay, you know, we have some clients that might say like, hey, cash is really safe, and shouldn't we want really safe assets, so why wouldn't we just put it all in cash? And then we have on the other end, hey, you know, maybe small cap value stocks have had historically really high returns, like should we just put it all in small cap value? And I wonder if you could speak to sort of, you know, the different, you know, what the role of the different assets are in the portfolio, and do they have over long periods of time the same returns or different returns, or how does that work with all those different assets?
Yeah, that's good, and is a good segue off of what we just talked about with goals and plan. But you also, I think at the most basic level, I think the thing to do is to really define risk in each of these different assets, or each of these different tools to achieve your stated goal. So let's do that, right? So let's go both ends of the spectrum. Cash is risky for some people. U.S. small cap, U.S. small companies are risky for some other people. And then there's things in between. There's broad market, there's value companies, there's, you know, international, there's all these different things in between. But to start, let's go on the outer edge, and that's cash. And then that is U.S. small cap stocks, U.S. small company stocks. So cash, how is that risky? You always hear, oh, that's the safe investment, right? Well, yeah, I mean, for some people it is. If your goal is within the first 3 to 6 months, cash is a good investment to own because there's low volatility to it. And I think that's the big reason why people assign that as a safe asset, because it's low volatility. But if I'm a 30 or 50 year investor, and I'm trying to achieve one of those goals that I set for myself, I may not be able to get by on a 0% return. In fact, I know I can't get by on a 0% return.
Yeah.
So then what's the next step up? Well, I can look at some money markets and things of that nature, which today that's a good idea if your goal is within 3, 6, 12 months. Money markets, short-term treasuries, they're paying 4 or 5.5%, just to give more of a range, and that's in 2024, right? As this video ages, that will change. But so that's where you start. What is my goal? What's my time horizon? Does this asset meet that time horizon? Quickly, to kind of put a bow on this, let's go to U.S. small cap stocks, or we can even just go to U.S. stocks in general and say, okay, well, first of all, you're in the stock market now, so you are going to have more volatility.
Absolutely.
And as a segue to that, if you didn't have more volatility, I would be more worried about it, because that means that stocks aren't acting like they should, because we know that that companies' earnings are different this quarter than last quarter. So there has to be some volatility.
Part of the price you pay to achieve those long-term returns is to stomach the volatility, and not just emotionally, but to truly have a time horizon that's long enough to endure the volatility, which not everybody does, and that's why stocks, 100% stocks especially, is not suitable for everybody.
And if it is suitable for you and you can stomach that because you have a long time horizon, that's your superpower.
Absolutely.
Time.
Yeah. I'm going to rattle off some nerdy stats here. So we can put this chart up on the screen, but the growth of a dollar, I think it's from 1987 to, I believe, the end of either 2022 or 2023. A dollar invested, just that would return inflation, would be $2.78, close to today. Putting it in, U.S. bond market, just the total bond market, a dollar would turn into $6.32, which is pretty good.
Yep.
6 times your money. Putting it in large cap stocks, $1 would have turned into $41.85. Small cap value stocks, $52.04. So just to give everybody an idea of how powerful investments returns can be over long periods of time. Now, I'll tell you though, the ride along the way would have been much smoother in those bonds. And that's what a lot of people talk about when they say risk, is like, is it a bumpy ride or not? But to your point, so many dimensions of risk beyond just, hey, is it up and down a lot along the way? There's, hey, are you going to outlive your money?
Right.
Does this asset have the return potential to be able to help you reach your goals?
And one of the biggest misconceptions is that, the first one that you said was inflation, and it comes to like $2.50 or something after that, which is still not a huge return. But if you're in pure cash, you're not even getting that. It's flat. It's zero. I guess are you adjusting that number by inflation, or would that be like your
after inflation? But so if you take cash minus inflation, you earn like 0.2% over that time period. It's not very much.
So it's that's just interesting to me. And you're rewarded for the risk that you take in the stock market. So that's why those small cap stocks have returned so much more.
Absolutely.
Now let's go to a fun topic of I'm a smart guy and I want to pick stocks. Not me, but it is. You hear it less and less, but you still, we run into those people sometimes that are like, hey, with a little bit of my money, I want to pick some stocks. So what do we think about that in general? Is it a good strategy? And if not, why or why not? And then we can throw the graphic up as well.
That's great. And there are a bunch of different questions there. So what do we think about it? And then also, is it a good strategy? 2 separate ones. I always make the joke of, if you tell me that you're going to go to Vegas to go play roulette, I'm not going to try to tackle you and hog tie you before you get on the plane, right? Like if you want to do that and that's, not going to wreck you financially, right? And you get a source of entertainment from that, then like it's your life, live it, right? Is it a good strategy to go to Vegas and play roulette to try to generate retirement income? No, probably not. If you're really good at poker, I don't know. There's a few people in the world that do that, but generally that's not a good strategy. And, picking stocks is clearly better than going to Vegas. I mean, in general, stocks go up over time. It actually, the statistics, I don't have them for cut out for this video, but maybe in a future one we can put it on there. You would be surprised at how many individual stocks end up going to zero over time. It's a good chunk of stocks end up with negative returns, and a large minority of them end up going to zero over time. And anyways, that gets back to the point of why we diversify over many stocks. We don't want to put all our eggs in one basket, but the difficulty of picking stocks is very real, and we've got some data we'll throw up on this. But basically, there's an organization called SPIVA. They're the organization behind the S&P indexes that a bunch of these funds kind of track or follow. And they track actively managed funds. So these are all the funds that try to do something beyond just replicate an index. They're buying and selling stocks based on which sectors they think are doing better, which stocks they think are doing better. And time again, what you find is after fees in those funds, the majority of them do not beat the index that they're compared to. So I think in the data we have in year one, about 75% of them don't beat the index. And that gets worse and worse each year that you hold on to the active funds. So year 2, even more than 75% don't beat the index. Year 3, even more than that don't beat the index. And what you see happening there is, every time you make a movement in a portfolio from one position to another, you're incurring some implicit transaction costs. Then also just paying the fund managers of these funds to try to actively pick stocks. They have salaries, they have families that they got to go home and support, right? And so you start to add in all this overhead. And so it's not just that you need to beat the stock market when you're picking stocks. It's that you need to beat the stock market after your expenses,
After cost.
which is even harder to do, right? And so, what we find time and time again is, picking stocks in the aggregate is a money-losing proposition, right? And so that's why we try so hard to stay away from, day-to-day movements in and out of certain strategies to reduce turnover, to reduce all those extra costs, because every time we incur those extra costs, we're just raising the bar higher and higher for how much smarter we have to be than everybody else.
Right.
And so, when we think about how do we want to generate higher expected returns, go back to that example about stocks versus bonds, right? It's not controversial for me to say stocks typically return higher than bonds. Does that mean that everybody who buys bonds is stupid? No, right? Because bonds serve a different purpose. They have a different risk profile over a different time horizon. So when we're picking asset allocation, we're not saying, hey, I think Wendy's is going to do good tomorrow because they just released a new chicken sandwich, or I think Pet Boys has great new products, or I think Lowe's is going to do better this Black Friday. We're not doing that. We're saying, hey, which asset classes for our clients have better return profiles relative to their risk? And we do hope to generate better returns for our clients, but it's the same thing as stocks versus bonds, right? Somebody who is maybe a little younger could have a higher allocation to stocks in their portfolio without materially risking their financial situation, right?
Sure.
And they will have higher returns because of that. That's not us going out and picking a certain stock. That's us aligning the broad asset class of stocks with their goals. And we do the same thing as it goes down into small cap value, mid cap value, mid cap growth, international emerging markets. So that filters down to all those levels. But it's kind of a fine distinction, but it's an important distinction from going out there and saying, hey, we're so smart that we know that this company is worth something different than everybody's paying for it right now. We're saying, hey, these types of assets are better suited to our client situation than they are to the general public situation, and the general public is the one that's setting the price for this asset.
Right. Well, two things on that. One, I could see someone saying, oh, well, I see all these commercials. It's free to trade stocks now. So what are you talking about with costs of trading? Well, I don't care if the trade is free. You still have just labor costs to account for, right? You're paying someone to do that. You're paying someone for their knowledge, and you're paying someone for their time to go and actually trade it. And then we can get it. You could get into the whole bid-ask spread, which I don't think we really need to
order flow,
and all of that. So even though your trade at whatever custodian you use is free, there's still costs in there, right?
Usually, if it's free, you're the product.
Yeah, there you go.
Yeah.
There you go. And the other thing is, you went through this data about who beats the market, what percentage actually outperforms their index, which is very low. It struck me, these are people that are paid to do that every day.
All day,
That's their job. So don't try to do it as an individual, right?
Absolutely.
So, it's just, if they can't do it, you probably can't do it either. I'm sorry, So anyway, enough on that. Anything else to tie up there?
I don't think so. It leads into another interesting question, though, which is sort of related. We get the stock picking question some, but I'd be curious how you answer. Sometimes clients will come to us and maybe all the tech stocks did really well last year, and so they want to invest in the tech stocks. Or, hey, real estate just got crushed, so let's divest from real estate. Or maybe it's the other way around. Hey, because real estate just got crushed, now's the time to buy. Let's go in. Or, hey, these tech stocks did really well, so maybe we should sell all of them and take our gains. So, what can you say about asset classes and how much kind of maybe last year's return in one asset class will relate to next year's return in that asset class?
This is a good one, and really for this one, I think the graphic that we have paints the picture, or sews the quilt, if you will, as good as I can even say it. But some things general principles that I like to discuss with clients and with friends and things is act, don't react. So in other words, let's build a portfolio that can capture all of those markets, or at least most of those markets, so that we don't have to chase which one did what last year. And as far as the question of what pattern is there, or what reliable pattern is there is I'm really like there's not one.
Yeah.
Sometimes you can find one, but how do you do that? And that kind of segues into the next thing we're going to talk about. But how do you find that pattern? You find it by looking at what they've done. It doesn't have anything to do with what they're going to do. And it's also not to say that in history you can't find some patterns of things that happen. You can, but that doesn't mean that they're going to exist the next time. If they existed every time, we wouldn't be doing this. We would be we would be trading on those patterns with our own money and be on some beach somewhere. So that's the going back to the whole quilt thing and the graphic is that look at the graphic that we put up there and you try to identify a pattern.
Yeah.
And you'll see that it's completely random and the final thing is just that's why we build portfolios to capture the market and then tilt towards places that should increase your return over time. But it's because that there's more reliability in that, and it's more towards the middle.
Absolutely. And we were putting together this graphic, and we got a really good suggestion from Kristen, who's an advisor on our team, to actually put on here a 70-30 portfolio in and amongst all these other assets. And I'm sure we'll throw it up on the video, but you can see, every year the top and bottom performing assets are just wildly different. It just looks like a jumble of colors. But that 70-30, it's not the dead middle every year, but it's pretty close to the middle of the pack every single year. And it's intentional, right? Because it's borrowing from all those different asset classes to try to smooth out the return a little bit. And it gets back into our earlier conversation of, maybe for some people, they don't need that 30% bonds because they can deal with some of the roller coaster ride.
Want it.
Yep.
Right? If I'm accumulating, I want more of that. Because when it goes down, I buy more of what I want, right? Just like your Apple analogy. If Apple prices go down, I can buy more, right? So if that's what I need, then I actually want the volatility. And so that's a good way to connect the two. Just kind of really riffing off of that. Is it reliable? Is it a good idea to choose things to invest in, to choose investment opportunities based on previous performance?
That's a good one. And this is interesting too, because sometimes we'll get into pretty deep conversations with some clients about what is our process for selecting funds and what do we look at. And sometimes it's somewhat surprising to them, I think, some of the things we do look at. I mean, the things we look at are, does the fund do what it says it's going to do? Does it fit into the portfolio in the gap that we have in the portfolio? So again, starting with the plan, the investment strategy, the allocation, then the funds. Do these funds fit into that area of the allocation that we need them to? Do they manage taxes effectively? Do they manage underlying turnover? So hopefully they're using the inflows and outflows from investors to minimize the amount they have to buy and sell. Because again, for them, every time they buy and sell, they're paying a bit-ask spread, they're driving up costs. So we're really looking at, when we look at funds, are you doing what you say you're going to do, and are you doing it really efficiently? Now, there's a whole other kind of school of thought or common thought out there of, I could go to Morningstar or whatever, and I could just look at all the best fund managers from last year, and I could just pick those guys or gals, and if they did great last year, surely they're going to do good this year, right? Like in the same way that you'd say, hey, if this player, hit a bunch of threes last game, maybe he's on a hot streak, he's probably good at shooting threes, he's probably going to hit a bunch of threes this game too. And that's just not true at all in the investment world. So what you find, we've got...
Or in the basketball world.
A lot of times, that's true. We've got basically a study, Speed, the same one I mentioned earlier, does this. They track fund performance. And it's a little complicated, but basically what this graphic shows is if you take the best half of U.S. funds in 2018, so, let's say there's a big group of funds, you take the best performing half of them as of 2018, and you follow those funds for the next 5 years, and you say, hey, okay, in year 2, how many of these funds that were the best half performers in 2018 still are in the best half of performance in 2019? It's a much smaller number. You go to 2020, it's a much smaller number. You go to 2021, it's a much smaller number. By the time you get 5 years out, only 3% of those original funds that were in the top half performing funds stayed in the top half performing funds that entire time. And actually, by random chance, we'd expect it to be more than 3%, which is not really to say anything either way, other than to say, it would be better to flip coins, or just as good to flip coins to guess which funds are going to over or underperform than to look at their prior performance to see what will over and underperform relative to their benchmark. And I guess the point on that, again, is that you need to have a level of conviction in the investment strategy, totally independent of the actual fund, right? Like, you know, going back to the Apple example, like, you know, if you had a random new kid every day and you were making their lunch for school, right? Like, some kids would like the apples, some kids would hate the apples, some kids would like oranges or whatever, right? And so it's totally unpredictable sometimes, like what's going to be rated or received the best in a particularly given year. So you really have to have conviction in, like, there is a reason that I have this thing.
Right.
And I have picked, you know, the way that I want to invest in small cap value or medium cap growth or international. Like, I'm choosing the fund based on what I think is the most efficient way to get that allocation versus, hey, I picked the best 5 funds. One of them's a Japanese bond fund. One of them's, Polish equities. Like, that's a bad way to make a portfolio, to just say, hey, well, all these things did well last year, because in 2 or 3 years, if it's not doing well, you're not going to be able to explain why are you invested in 1/5 Japanese bonds and 1/5 Polish equities, right? Whereas if you have a sensible allocation that's built on long-term data, you'll be able to say, hey, you know, my international stocks might be down, but I understand why I'm invested in them. I have confidence in the fund that I've used to invest in them. It's efficient. It keeps expenses low. It has low turnover. And so I'm able to ride that decision out, because one of the most important things in investing is having a plan that you can stick to.
That's it. That's good. So go back to the 3% real quick, and that was over 5 years. Tell me what that represented one more time.
So over 5. So if you took the funds, if you took all the funds, U.S. funds in 2018, and you only followed the ones that were the top half performers, if you follow those, and 5 years later you say, hey, what portion of all of you were still top half performers in every single year, 5 years in a row? Only 3% of them were. And just by random chance, you'd expect something like 6.25% to have been top performers. If you just started flipping coins, right, you'd expect about 6% of them.
Right, and that's why we're never going to take us out of it. We don't recommend to anyone to stake your entire life savings and your entire financial plan on a star manager, right, or one of these actively managed funds. Base your strategy in your portfolio and your life savings. Base it on academic research, things that exist, things that have proven themselves to us over time, which we'll get into in just a minute. Base it on that, not on is Susie going to outperform this year, or is Steph Curry still going to be shooting the most threes in 5 years from now than anyone else, right? Yeah. Which that's already getting outdated. So, that's a good example of why you need to have a good foundation in your plan. We're not chasing past performance. We're not chasing this person had a good year last year. So
absolutely.
So another thing that I think a lot of folks actually don't know about, or maybe some misconceptions, or maybe they just don't know at all. They haven't researched this. This isn't what they do in their everyday job, is just kind of the history of our industry. The finance industry, the financial planning industry, portfolios in general. So why don't we talk a little bit about that, about how it's developed, and maybe some things that have come from it. That would be good if you could shed some light on that.
Yeah, well, this analogy is going to dramatically exaggerate the importance of us professionally. But if I compared us to like the medical profession, right, there was a long time where doctors, like, in the 1300s, like, what could a doctor do? They might like cut off a limb or something that looked infected, or they didn't know to wash their hands, and there's a long time where the medical profession wasn't particularly research-based, science-based, things like that, right? And then penicillin came around, and they started developing antibiotics and things, and now there's tons of research behind like antibiotics, and it would take, as an example, a whole lot of research for us to lose confidence in, hey, do antibiotics actually work? If I'm sick or I have an infection in one of my limbs, like, antibiotics probably are the way to go, and a lot of us have confidence in that because of years and years of research. Finance was a lot like that up until around the 50s. Is people, stocks were out there, but there wasn't a lot of research into the theories of why stocks had returns and how you could fit them together in a portfolio with bonds and things like that. So really, since around the 1950s, there's been layers of research, academic research into, starting with the building blocks of like, hey, why do some assets return more than others? And from that, we get kind of the basic risk return relationship in a model called CAPM. We get kind of the beginnings of how to construct a portfolio. The idea is that you can take some less risky assets and some riskier assets, put them together, and you can make an efficient portfolio for somebody's goals. Then the 70s come around, people notice, hey, it seems like some, assets have higher returns than we would expect to based on our conventional measures of risk, which is kind of volatility, how bumpy the ride is. And then you've got papers coming out with, hey, maybe there's different elements of return than just the volatility or the traditional standard of risk. Maybe there's a premium to smaller companies, or there's premium to companies that have a low price relative to the book value of their assets, or more recently, maybe there's a premium to companies that have high profitability, or maybe there's a premium, you can think of it one way, or kind of an anti-premium to companies who grow their balance sheet too quickly. Mm-hmm. So in companies that grow so aggressively, maybe they're doing it inefficiently. And the point of what I want to make in it is we use this research to help guide sort of our allocations. We never make 100% bets on certain things, but we'll tilt our portfolios towards and away asset classes we think have better risk return characteristics for our clients. But the point I would make on all that is it's all based on decades and decades of incremental research, mm-hmm. where ideas are being kind of flagged and then refined, mm-hmm. and it's usually 2 or 3 different academics at different points in time that layer on to contribute to our understanding of just one particular part of the investment universe. Mm-hmm. And of course, then our job is to take all that complexity, find out which investment vehicles are delivering the types of allocations that we want to achieve those goals, and then the ultimate job to be able to communicate that effectively to somebody, help integrate it into their plan and help stay on the plan long term. Mm-hmm. And that's we're going to go all the way from the really nerdy investment research part of it, which I love. Mm-hmm. So I want to ask you a kind of more, I don't want to say more basic question. In a lot of ways, it's a more complicated question because it doesn't have a neat, tidy, spreadsheet type answer. But one challenge to all this stuff we've talked about is on the other side of a portfolio is a human being that is experiencing ups and mm-hmm. downs, and news headlines are coming in. Mm-hmm. They're probably happy when their portfolio goes up. They're probably upset when it goes down. Mm-hmm. Sometimes they might be nervous, even if it's gone up, that, oh my gosh, what if it goes down? I guess, can you talk a little bit about, I know I'm probably asking you to crystallize everything it is to be an advisor into a 2-sentence response, but mm-hmm. What advice do you give to clients that, are having, a desire to make emotional decisions in their portfolio, mm-hmm. or they let news headlines kind of get to them and they want to change the plan based on headlines or things like that. Mm-hmm. Do you see that? I guess is one question, and then mm-hmm. what's your advice, or is it always different?
We do see it. We're fortunate to have worked with clients for a lot of our clients for a long time, and that's the favorite part of my job is kind of the coaching aspect of it, because and the mesh between everything you just talked about and that, that's really why I love my job, is because I like the technical, I love studying that, I love knowing that, but really what I love is bringing that to people that don't have the time or desire to know all that and to study all that, and it's bringing it to them and communicating it to them in terms they can understand. And I think that's one of the biggest things. To basically what you're asking is, how do you help people control their own emotions? How do you help people stay out of their own way? I think first people have to understand what we're doing at the level that they want to.
Yeah.
And then I think obviously there's trust there and things like that, but they have to understand it so that they can understand that, hey, portfolios go up and down. That's a normal event. We expect the market to go down intra-year somewhere around 15% almost every year. Well, why would you invest in stocks? Well, because by the end of the year, it usually ends in positive territory. So, but with that is the emotion of it. And so with everything you just discussed, that's all being assumed that people are logical and they act logically. But the thing is, we know that it's scary when times are tough. It's scary when the market's down 50 some odd percent, the stock market's down 50 some odd percent. It was in 2008. There's the COVID example, which is actually a really good example. Yeah. Goes down sharply, comes back sharply. Mm-hmm. So our job is to help people through those times and to get out of their own way. And you mentioned the headlines, to really avoid. those headlines, I shouldn't get on my soapbox too much here, but those headlines are created to sell TV space. That is a revenue generator. And so, if your goals are aligned with your plan, you should ignore those. Mm-hmm. What does that mean? Well, if my goal is to pull my money out in a week, I should have never been exposed to that stock anyway. Yeah. If my goal is to pull that money out in 30 years, why do I care whatever talking head, I'm not going to name a name, why do I care what a talking head says on the evening news about this stock or Tesla stock or Apple stock or doing this, that, and the other? I don't care, because that's not my time horizon. That's not my goal. So back to tying this all together. We have all this data. We're not basing our portfolios on star managers, because that's not a reliable thing to do. We're basing it on years of research, academic research that's been refined over many, many years, because that gives us a good base. So if we have a good base, now what we have to do is make sure that we don't shoot ourselves in the foot. Mm-hmm. And that's why advisors can be valuable, to help people manage their emotions, get away emotionally from their investments. We have some people that frankly could do this. They're very smart. They've studied this a lot, but they know that if they can separate themselves from the investments, that will allow them to go focus on what's most important to them instead of focusing on what's going on in their portfolio. They pay us to do that for them.
So. One thing that I always think about is, a nerdy way to say it would be there's a lot of correlation there, but some of the toughest times in the markets are tough times personally for people.
That's right. Yeah.
And so, one thing to think about when you're thinking about, and this is what you all do such a great job of, but when you're thinking about your allocation, I love what you said there about, the right time to think about those risks is before they occur. Mm-hmm. You need to make a plan for how the airplane's going to fly before it gets in the air.
That's right.
And just keeping in mind that, it's easy to say you're going to be emotionally strong and you understand the long-term data and you get it. It's different when it's 2008 and with the largest investment bank in history just went bankrupt. Yep. And nobody knows exactly what's going to happen next. Mm-hmm. We're in 2019. Oh wait, there's this virus that I didn't even know existed a month ago, and now, my friend's business is shuttered. For who knows how long. I'm staying home from work. My kids home from school. All kinds of other real life things happen in those really, really challenging times. And I think that's why it's so important what you all do to help build a lot of confidence in the plan beforehand, because you're just not, more than likely most people, at that same time that they're challenged emotionally in their portfolio, there's a good chance that the world around them is going to be challenged emotionally in life. And it's just, there's not going to be a lot of bandwidth to try to come to terms with your risk appetite and your plan, at that time. And I think that's why it's just so valuable to have these plans we talk about, have talked about that stuff in advance, have a lot of confidence in, hey, even in these down scenarios, what could happen in the portfolio and what assets are we invested in to help buffer against those scenarios. But just being able to engage with an advisor regularly, annually ideally, to be able to do those check-ins, to understand where you stand so that at any given time, hey, if something in the world's happening that's crazy, like I have the confidence to know this part of my life's taken care of and I can focus on everything else that matters. That's huge. That's huge.
That's a really good point. And the last thing I'll say on this, and we can jump to our last couple topics, is that when you were going through those examples, something that we do hear from people, friends, clients, is that, hey, this time feels different. And I'm not making fun of those people. I understand that. And the reality is that every time is different. Yep. It's always different than the last one. But the markets have been resilient through those events, but in every one of them, it feels just as heavy, just as hard, or maybe even more, right? They're all different. And so it's easy when it feels new and different. It's easy to be emotional. I don't blame people for doing it. But what we have to do is we have to define a way to make these decisions, and then we have to stay consistent and logical in doing so throughout time, because there's really no better option, right? We have to have a plan, and we have to stick to that plan because it's it's the way to manage money. It's the way to implement a plan. So
absolutely. Well, I'll get to the last question I have for you that kind of ties all of it up, and this is another really challenging open-ended one. So we talked a bunch about the plan. You need to have a plan. You need to consult the plan. You need to have goals. Goals need to be tied to the plan. The investment strategy comes from the plan. So I guess not to put you too much on the spot, but what is the plan? Like a client comes in, a client says, okay, pretend I guess it's a new client, right? That they say, hey, okay, I hear this. It sounds important. It sounds like I need a plan. Jake, let's do a plan. What do you guys do? I mean, are you, talking about specific stock tickers? Are you, pouring through their tax return? What are you doing? What is the plan?
Yeah, it is broad. There's a lot there, and it's also very individual. We don't have a, okay, here you go. Thanks for stopping by. But there's some similarities in all of them. So first of all, we want to look at the whole picture with a family or an individual. We want to look at their entire financial picture, which is far beyond just their dollar signs or their stock tickers, right? It includes okay, what are your goals, which is obvious. We've hit on that quite a bit. When what's your time horizon, and in those goals and in that time horizon, is this multi-generational, or are you going to spend all this money in your lifetime? Most of the people that we work with typically have a plan to pass money in some form. So without going too deep into that, I do want to say that one of the biggest things within a financial plan is, number one, it's asset allocation, which we have done videos on that. We should do more, but that's multi-level. Asset allocation is multi-level. There's high-level stocks, bonds, cash, real estate. What other assets do you have? And then you can go deep as subsector of sector and then subsector. So and what countries are you in and things of that nature. So that's a big part, but that's your investment portfolio, right? I think that's the one that people most identify with that we do as far as a financial plan. But then we have to go into, okay, what are your other goals? Well, my goal is to send my child to college or to trade school, whatever. Okay, well, we need to do some education planning. So you're saving for retirement over here. We need to also do some education planning for saving over here. Oh, by the way, I make up a number. I make $1 million a year. Okay, well, you might need some tax planning. Yeah. So we need to figure out where to save that can help you on your on taxes, save on taxes. And oh wait, by the way, also I want to leave, again, I'm making these numbers up, pulling from thin air. I want to leave $5 million to my kids for one reason or another. Okay, well, you're going to need some estate planning, right? Yeah. Are you over the estate planning exemption? We don't draft estate documents, but we look into that and we say, okay, you're over the estate planning exemption. Well, you're going to have to pay 40 to 50% tax on any dollar that's above that exemption. We want to plan for that before you have to do it. Let's do some advanced gifting and things of that.
Can I jump? I want you to keep going after this, but just to jump into on that, because I think some of those things some people might hear and think, well, do I need that element of a plan? But even just on those things you mentioned, naming beneficiaries on your accounts is a huge one. I've experienced a parent that passed and how much more difficult it can be if you're not organized, right? And have beneficiaries named and things like that. Taxes, there's people that need really aggressive tax planning to save money, but every person that is engaged with an advisor would benefit from sharing basic tax information like your marginal federal rate with that advisor, because I can tell you, as the chief investment officer here, an investment decision is being made. There are taxes related to those investment decisions. There is an implied or explicit tax rate that goes into the calculation of, should I buy this tax lot or sell this tax lot? Like, there are tax decisions being made every day in a portfolio with complete and good information, or partial, less complete information but good guesses, or totally incomplete information. And the better planning you do around that, the more it can feed the rest of the portfolio and add value in a bunch of other areas. Keep going on the rest of it, but I just wanted to drill into those really tiny,
and to your point, which something you said earlier, that's why we regularly meet with people, and why it's a good idea to engage with your advisor, because those things change.
Yes.
And the best way to frankly get the most out of your advisor is to keep them updated on those changes so that as things change in your life, things can change in the way we're implementing your portfolio or your plan. Right? Because we may do something, it's not a huge difference, but we may make a different decision if we know this or that about you. So the other areas of a plan, rebalancing, most of what I'm talking about is investment based. I'll try to hit the others quickly. But rebalancing, I mean, that's a basic thing, but if done well, if done poorly, it can lead to really bad results because
extra taxes and all kinds of things.
Yeah, and your portfolio looks nothing like it did 20 years ago because you never rebalanced it. And if done well, it can really help you and support your goals. Other areas of planning are we've never sold insurance, we don't sell insurance, we're fee only. But that's a part of people's plans. We need to look at that. And even if I'm just an individual investor out there watching this video, well, that's part of my financial plan. What's going to happen if I die? What's going to happen to my family? Or will they be supported for a certain period of time based on my goals? And what else? So I talked about investment management.
What about? Let me ask this. So let's say I'm early in life and I'm accumulating, and I want to retire with a certain amount of income. And I need to come up with a number to save. Or let's say that I've already saved a lot, and I'm about to retire, and I want to know how much to spend. How does that work? Do you guys have a big magic 8 ball you shake? Do you go in with a calculator? You do all the math in your head? What does the plan look like in that respect? And does it change?
That's good. And really that's the place to start, especially if you're an accumulator. But that's one of the best things that an advisor can do for you early on is just tell you one, how much you can one of two things, or maybe a handful of things is one, how much can I expect from my current portfolio if I never save another dollar? That would be more of someone that's about to retire and wants to know if they can retire. Mm-hmm. That's such a powerful thing we can do. We can answer that question for them so that they can leave here and know, hey, I actually don't have to work another 5 years. I can retire whenever I want. Mm-hmm. I love when we get to do that. Yeah. That's a blast. And I love just as much the other side of that. It's, hey, we have some excess income that we could save towards a goal. First of all, what should our goal be? I actually get asked that question. What should our goal be, right? Some people don't know that. They've not thought about it. I don't blame them. They've just not thought about it. So what should our goal be? But number two is how much would we have to save to get to that goal? So we use, as you well know, a Monte Carlo simulation. We also use some different software, but and you asked about the calculator. I used to be able to do it on a calculator. I'm not sure if I can remember those inputs, but we put those numbers in, and what we can do is we can kind of say, all right, you want to spend $200,000 a year in retirement. Again, completely made up numbers. Well, we can work backwards from that, and we can actually get to where we can tell you, hey, you know what, you and your wife, you need to save, $2,000 a month for the next 30 years to retire and be able to meet your goal. And so we are leveraging software. We're using Monte Carlo simulations. And when we run those, we're not trying to be 100% correct. Yeah. And that's okay. I would rather have some vague idea of what the future looks like than have no idea at all. Yeah. And that tool right there is what we can base our other planning actions on. So
yeah, absolutely. The high scenarios in those might feed the estate plan of
yes.
Your base case doesn't get into really high estate plan needs, but hey, if things go a little bit better than expected, which they do about half the time, maybe estate planning does come into it. And I think it's my favorite thing as a nerd about that tool is how it doesn't just speak to, hey, what's probably going to happen, but what's the reasonable range of outcomes that we're looking at, right? I mean, nothing's guaranteed, right? AI could have super productivity tomorrow and we're all wealthy beyond our imagination. An asteroid could hit in Texas and we're all in trouble, right? Yeah. I mean, the two ends of the spectrum are always wild. But that software can give a really good idea of hey, what's sort of the reasonable range of outcomes and how can I plan for, not just the base case, but what if we have a really good outcome? What if we have a less than good outcome? Just sort of, again, helping mentally prepare for what are the possibilities in the future? And like I said, I'm the investment nerd. But I guess my kind of closing thoughts would be, I always go back to, I try my best not to get lost in the weeds of the investments, even though I love them when I'm talking to clients, of the most important thing is the plan. 100% the most important thing is the plan. The next most important thing is the allocation, your balance between stocks and bonds. Mm-hmm. Then it's the investment strategy. Yep. then it's the funds you allocate to under that investment strategy.
Yep.
And one of the biggest mistakes you can make as an investor is to get that flipped, is to
right.
start picking funds and then realize, oh, okay, well, I guess this is the investment strategy I have because of that. And then say, like, well, what should I plan to do with this money? Absolutely the backwards way to do it. If you really want to be efficient, and I mean, that's maybe kind of a nerdy clinical word to say, but if you want to be able to have abundance in your life and have, free time and the resources to be able to do what you want to do outside of your portfolio, I mean, starting with a plan, starting with an advisor, and working your way down to a portfolio is absolutely the best way to do it.
That's where it starts. Set the goals that inform the plan, and then worry about the portfolio. Well, I think we can wrap there.
Yeah, that's great.
This was the first longer form video. I thought it went great. I enjoyed it. So hopefully we'll get some feedback and hear from people if they like these better. And we'll also chop them up to where we can show kind of the individual topics. But if you enjoyed this video, you are more than welcome to check out our other videos and to watch this in its entirety. If this is a clip, you're more than welcome to click the link that we'll put above or below and watch the rest of our videos in this long form video. Thanks a lot.